Right now, depending on which state you live in, part of your Social Security check might be getting taxed twice. Once by the federal government and again by your own state. And most retirees have no idea it is even happening. By the end of this video, you will know exactly which category your state falls into, exactly what form protects you, and exactly what a real retiree lost and then recovered by not knowing this one rule. Before we go further, hit subscribe. State tax rules on retirement income change almost every year, sometimes in your favor, sometimes not, and this channel tracks every update so you are never caught off guard. Here is what almost nobody explains clearly. The federal government can tax up to 85% of your Social Security benefit, depending on your total income. That part most people have heard about. But what almost nobody talks about is that on top of that, a number of states add their own tax on Social Security income or on pension and retirement account withdrawals, unless you know exactly which form to file and which exemption to claim. Let's quickly cover how the federal side even works, because it matters for understanding the state side later. The federal government uses something called your combined income. That is your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. If that combined number is above a certain threshold, a portion of your benefit becomes taxable at the federal level. For a single filer, that threshold starts around $25,000. For a married couple filing jointly, it starts around $32,000. Cross a second higher threshold, and up to 85% of your benefit can be taxed. That is the federal layer. Almost every retiree eventually learns about this one, usually the hard way the first time they see it on their tax return. The state layer is where things get misunderstood. Let me tell you about Diane. Diane is 71 years old. She spent 34 years teaching middle school, and she retired with a modest pension, plus her Social Security benefit. Total combined income, a little over $42,000 a year. Comfortable, not wealthy. When Diane moved to be closer to her daughter, she did not check how her new state treated retirement income. She just assumed retirement income was retirement income everywhere. It is not. In her first year in the new state, Diane paid an extra $1,380 in state tax on income that would have been completely exempt where she used to live, money that came directly out of her Social Security and pension checks, because she never filed the exemption paperwork her new state actually offers to retirees. Once she found out, she filed the correct state exemption form, and the very next year, that $1,380 stayed in her pocket. Diane is not unusual. This mistake happens constantly, especially when people relocate for retirement without checking the tax rules first. Now let me tell you about a very different case. Robert. Robert is 68, retired early from a corporate job and lives mostly off a 401k and a small pension, no Social Security yet. He assumed that because his state has no general sales tax, it probably did not tax retirement income either. Those two things have nothing to do with each other. Robert's state does tax pension and 401k withdrawals for residents under a certain age, but has a separate, more generous exemption once you turn 65. Robert was 68, already past the age threshold, and never filed the form. He left roughly $960 a year in unclaimed exemption on the table for 3 straight years before a tax preparer caught it. 2 completely different retirees, 2 completely different mistakes, same root cause. Nobody automatically applies these exemptions for you. So let's break down exactly how this works, because the rules are more specific than some states tax it, some do not. First, most states do not tax Social Security benefits at all. The majority of states have fully removed Social Security from state taxable income. No forms required, no income limit to worry about. If you live in one of these states, your Social Security check is simply not part of your state tax calculation, period. Second, a smaller group of states do tax Social Security, but only above a certain income threshold. In these states, if your total retirement income stays under a specific number, your benefit stays exempt. Go over that number, and a portion becomes taxable at the state level. This threshold is usually somewhere between $50,000 and $100,000, depending on the state and your filing status. Third, separate from Social Security, many states also offer an additional exemption specifically for pension and retirement account withdrawals once you hit a certain age, usually 65. This is a completely different exemption from the Social Security one, and you typically have to claim it separately on your state return. This is exactly the exemption Robert missed. Fourth, none of these exemptions apply automatically just because you turned 65. Your state does not cross-reference your birth certificate and quietly adjust your tax bill. You, or your tax preparer, have to actually claim the exemption on your state income tax return every single year. Now, here is a common point of confusion I want to clear up directly. Having no state income tax at all is not the same thing as having a specific retirement income exemption. A handful of states charge no income tax on anyone for any kind of income. In those states, obviously your Social Security and pension are untouched, along with every other type of income. But a much larger group of states do have a general income tax and still choose to specifically carve out Social Security, pension, or retirement account income as exempt. Both situations end with you owing zero state tax on that income, but they work through completely different rules, and if you are only checking, "Does my state have income tax?" you might miss important details about how pension versus 401k versus IRA withdrawals are each treated differently. Here is a concrete comparison. Say your combined Social Security and pension income is $48,000 a year. In a state with no tax on retirement income, your state tax bill related to that income is zero. In a state that taxes retirement income without the senior exemption properly claimed, that same $48,000 could cost you between $1,200 and $2,400 a year in state tax, depending on the state's rate. Over a 20-year retirement, that gap adds up to tens of thousands of dollars just from one line on one form, filed or not filed. Let's talk about a few specific situations people ask about constantly. What if you are still working part-time while collecting Social Security? Your state retirement exemption rules generally apply to the retirement income itself, your Social Security and pension. Your part-time wages are usually taxed under normal state wage rules, completely separate from the exemption we are discussing. Do not assume working part-time disqualifies you from claiming the retirement exemption on the income that does qualify. What if you have a Roth IRA? In most states that tax retirement withdrawals, qualified Roth withdrawals, are already federally tax-free, and states generally follow that federal treatment. This is actually one of the few areas where the state and federal rules tend to align closely, though you should still confirm with your specific state. What if you inherited an IRA from a spouse? Inherited retirement account rules can be more complex, both federally and at the state level, and this is a case where it genuinely pays to sit down with a tax professional, rather than assume the standard senior exemption applies the same way. And here is one more situation that trips people up constantly: moving states in the middle of the tax year. If you relocate in, say, June, you do not simply pick whichever state's rules you like better for the full year. Most states require what is called a part-year resident return, splitting your income between the state you lived in for the first part of the year and the state you lived in for the rest of it. Your Social Security and pension income gets allocated based on which state you were a resident of when you received each payment, not based on which state has better rules. This means if you move from a no-tax state to a state that taxes retirement income partway through the year, you could suddenly owe state tax on the months you lived there, even if you were exempt the entire year before. Retirees who plan a move for October or November sometimes do not realize the new state's rules already apply to that portion of the year. If a move is on the table, This is worth mapping out with a tax preparer before you sign a lease or close on a house, not after you have already relocated. Let's also talk about where to actually go to check your own state's specific rules, because look it up online is not always as simple as it sounds. Do not rely on a general search engine summary or an AI chatbot answer for this, because these rules change yearly, and generic answers are often out of date or written for a different state than the one you are searching from. Go directly to your state's Department of Revenue or Department of Taxation website. Look for a section labeled Retirement Income, Pension Exemption, or Senior Exemption. Most states publish a specific worksheet or instruction booklet for exactly this calculation, usually attached to the state income tax form instructions. If you use a paid tax preparer, ask them directly, does my state exempt Social Security, and am I claiming every retirement income exemption I qualify for? That one question, asked explicitly, catches most of the mistakes we have talked about today. So here is what you actually do, step by step. Step 1. Find out exactly how your specific state treats Social Security income and retirement account withdrawals. Every state's Department of Revenue publishes this, usually under a page called Retirement Income or Senior Exemptions. Step 2. If your state has an age-based exemption, typically starting at 65, confirm you are actually claiming it on your return. This is frequently a specific line or schedule, not something automatic. Step 3. If you are thinking about relocating in retirement, check the destination state's tax treatment of retirement income before you move, not after. Diane's mistake is completely avoidable if you check this one thing in advance. Step 4. If you already filed without claiming an exemption you qualified for, most states allow you to file an amended return. Depending on your state, you may be able to go back multiple years and claim a refund for exemptions you missed. Step 5. If your income is close to one of these thresholds, a small change, like the timing of an IRA withdrawal, could keep you under the line entirely. This is exactly the kind of decision worth reviewing with a tax preparer before year-end, not after you file. None of this is legal or tax advice specific to your situation. Every state's rules are different. They change from year to year, and your exact numbers depend on your full tax picture. Talk to a tax preparer familiar with your specific state, or check your state Department of Revenue directly. Let's bring it together. Most states do not tax Social Security at all. Some do, but only above an income threshold. Separately, many states offer an extra exemption for retirement income after 65, and that exemption is completely different from having no general income tax. None of it happens automatically. And if you already missed it, an amended return may still get some of that money back. If this helped you see a blind spot in your own retirement plan, share it with someone who just retired or is planning to relocate. It could be the difference between paying tax on money that was never supposed to be taxed and keeping every dollar you are actually entitled to keep. Subscribe if you have not already. Every week we cover another rule that could be quietly costing you money in retirement. We will see you in the next one.